I have seen brilliant minds fail, not because they lacked intelligence, but because they lacked the discipline to see the market for what it truly is: a vast, complex system of data, not a drama of human sentiment. The rule that separates the perpetually wealthy from those who merely chase their tails is not a secret trading strategy. It is a fundamental shift in perspective, a rejection of the emotional narrative that the middle class clings to, and an embrace of the mathematical reality that governs all success. The traditional approach to money is a failure by design. It is built on gut feelings, on the latest headline, on the fear of missing out, and the panic of a downturn. This is the mindset of the gambler, not the investor. The middle class, in their pursuit of financial security, are taught to follow narratives, to buy the stock everyone is talking about, to sell when the news is bad, to let their personal hopes and anxieties dictate their decisions. This is the first fatal mistake: confusing noise with signal. They treat the market as a casino where luck is the primary variable, when in reality, it is a vast, imperfectly predictable machine where logic is the only currency that matters. The wealthy, the truly successful, understand that the market is not about what you feel should happen, but what the data suggests is most likely to happen. They follow three core principles that are fundamentally mathematical, not emotional. My work at Renaissance Technologies was built on a simple yet revolutionary premise. You do not need to be right all the time, or even right by a large margin, to achieve extraordinary success. You only need to be right slightly more often than you are wrong, and you need to execute that small edge relentlessly. Consider the flip of a coin. If I told you that this coin was weighted and it would land on heads 50.75% of the time, would you bet on it? Most people would dismiss the edge as insignificant. They are looking for the grand slam, the 80% certainty. But a 50.75% edge, executed thousands of times a day, is not a small advantage. It is a mathematical certainty of profit over time. This is the rule the rich follow. They seek out small, repeatable, and quantifiable advantages. They do not look for a single, massive win. They look for thousands of tiny, almost invisible wins that, when aggregated, create an unstoppable force. The middle class, conversely, seeks the perfect trade, the one stock that will make them rich overnight. They wait for the moment of maximum certainty, which, ironically, is the moment the advantage has already evaporated. They are paralyzed by the need for a large edge, and in doing so, they miss the continuous stream of small opportunities that are the true source of compounding wealth. We built a system that did not care about the why, the narrative, only the what, the statistical anomaly. We were content to make a few basis points on a trade, knowing that the sheer volume and frequency of those trades would render the small edge into a colossal advantage. The lesson is clear. Stop searching for the perfect prediction and start searching for the persistent, tiny inefficiency. To truly grasp this, you must understand the concept of statistical arbitrage. It is the mathematical foundation of our success. The market is a collection of millions of tiny, temporary mispricings. These mispricings are not caused by fundamental shifts in value, but by the friction of human interaction, the delay in information flow, and the sheer volume of transactions. A traditional investor, focused on a company's long-term value, would ignore a stock that is momentarily mispriced by a fraction of a percent. They see it as noise. We see it as a signal. We develop models that could detect these fleeting anomalies: a stock that has moved slightly out of sync with its correlated peers, a futures contract that is momentarily too cheap relative to the underlying index, or a currency pair that exhibits a predictable mean reversion tendency over the next few minutes. The edge is not in predicting the long-term direction of the economy. The edge is in predicting the next 5 minutes with 50.75% accuracy. The power of high frequency is the power of the law of large numbers. If you have a positive expectation, no matter how small. The more times you execute that expectation, the closer your actual results will converge to the theoretical expectation. A single coin flip is pure chance. A million coin flips with a 50.75% bias is a guaranteed profit. The middle-class investor makes a handful of large, infrequent bets, subjecting themselves to the tyranny of small sample size, where variance can easily wipe them out. The wealthy quant makes thousands of small, high-frequency bets, ensuring that the mathematical expectation of their system is realized. We are not betting on the future. We are betting on the stability of statistical laws. We are trading time for certainty. Every second that passes is another opportunity to execute a trade with a positive expectation, moving us closer to the inevitable, mathematically driven outcome. This is the essence of compounding, not just capital, but probability itself. The market is a river of data, and we are simply dipping a cup into it thousands of times a day. The cup is small, but the river is endless. Let us delve deeper into the nature of this small edge. It is not a secret formula, but a superior understanding of the signal-to-noise ratio. In the financial markets, the noise, the random, unpredictable fluctuations driven by human emotion and external events is immense. The signal, the underlying exploitable pattern, is faint, often buried deep within the data. The traditional investor attempts to filter out the noise by focusing on long-term fundamentals, effectively ignoring the short-term market movements. This is like trying to hear a whisper by standing a mile away. Our approach is the opposite. We use sophisticated mathematical and computational tools to amplify the signal, to isolate the tiny, non-random component from the overwhelming randomness. This requires a level of computational power and statistical rigor that is simply unavailable to the average investor. We are not smarter than the market. We are simply more systematic in our search for its imperfections. The middle-class investor often confuses a trend with an edge. A trend is a publicly observable phenomenon already priced into the market. An edge is a temporary, non-obvious statistical anomaly. By the time a trend is clear enough for the emotional investor to act on it, the opportunity for outsized profit has vanished. Our models are designed to detect the precursors to a trend, the subtle shifts in momentum, or correlation that signal a temporary imbalance. This is why the high-frequency component is so crucial. These imbalances are corrected quickly, often within minutes or even seconds. The wealthy quant is not a long-term speculator. He is a short-term liquidity provider, capitalizing on the market's need to constantly rebalance itself. The philosophical implication is profound. You must accept that your profits will be small on a per-trade basis. You must be content with the fraction of a percent, because that fraction, multiplied by millions of trades, becomes the foundation of a financial empire. The pursuit of the large single profit is the emotional trap, the acceptance of the small. Repeatable profit is the mathematical liberation. The second fatal flaw in the emotional approach is the inability to accept loss. A loss is not a moral failing, it is a data point. When a trade goes against the middle-class investor, they experience pain, fear, and a desperate need to be proven right. They hold on, hoping the market will validate their initial flawed hypothesis. This is the sunk cost fallacy in its purest form, and it is the quickest path to ruin. The wealthy, the quant, the disciplined investor view a loss as a necessary cost of doing business. They predefine their risk, they have a system, and that system includes an exit strategy for every scenario. The stop loss is not a sign of defeat, it is a mathematical boundary, a line drawn in the sand, by logic, not by hope. When the system says sell, you sell. There is no debate, no second guessing, no emotional attachment to the asset. I recall an early model we developed that, for a period of 2 weeks, performed spectacularly. Then the underlying market dynamics shifted and the model began to bleed capital. The emotional response would have been to tinker, to adjust, to desperately try to save the model. Our response was to shut it down. The data told us the model's predictive power had degraded below our threshold. It was a failure, but a controlled, quantifiable failure. We learned from the data, discarded the flawed system, and moved on. The middle class holds on to a losing position until it becomes a catastrophe. The rich cut their losses quickly and redeploy their capital where the probabilities are more favorable. Your system must be your master, and your emotions must be irrelevant. The critical concept here is maximum drawdown. The emotional investor focuses on the potential upside, ignoring the inevitable downside. The disciplined, wealthy investor focuses on the downside first. They ask, what is the maximum loss I can sustain before my system breaks, and how do I ensure I never reach that point? This is a question of survival, not profit. The stop loss is the mechanism that enforces this survival. It is the mathematical governor on the engine of speculation. The middle-class investor views a stop-loss order as a prediction of failure, a negative thought that might jinx their trade. They believe in the power of positive thinking over the power of probability. This is magical thinking, and the market is an unforgiving place for magicians. We understood that every trade, even those with a 50.75% positive expectation, has a 49.25% chance of being a loss. To survive the inevitable sequence of losses, the drawdown, you must have the emotional fortitude to accept them and the capital preservation rules to withstand them. The emotional investor, after a string of losses, experiences recency bias and loss aversion. They become paralyzed, or they double down in a desperate attempt to recoup their losses, transforming a small, acceptable loss into a catastrophic one. The system, however, has no memory of the last trade. It simply executes the next trade based on the current data and the predefined risk parameters. This is the freedom of the system. It frees you from the tyranny of your own psychology. The wealthy investor understands that capital is a resource, and a loss is simply the cost of acquiring new information. When a trade hits its stop loss, the system has delivered a clear message. The initial hypothesis was temporarily incorrect, or the market dynamic has shifted. The emotional investor argues with the message. The wealthy investor acknowledges the message, preserves the remaining capital, and immediately seeks the next statistically favorable opportunity. This is the difference between a reactive, emotional approach and a proactive, systematic one. The stop loss is the single most important rule of capital preservation, and capital preservation is the single most important rule of long-term wealth creation. You cannot compound to zero. Let us consider the psychological biases that the system is designed to overcome. The middle-class investor is a victim of anchoring bias, clinging to the original purchase price of an asset as if it holds some intrinsic sacred value. They refuse to sell at a loss because it means admitting they were wrong, a deeply emotional and ego-driven decision. The system, by contrast, has no ego. It only sees the current price relative to the predefined risk threshold. The moment the price crosses that threshold, the trade is closed. This is a purely mathematical decision, devoid of the human need for vindication. Furthermore, the emotional investor suffers from confirmation bias, selectively seeking out information that supports their existing position and ignoring contradictory data. They will read articles that justify holding a losing stock and dismiss warnings as fear-mongering. The systematic approach, by its very nature, is designed to be anti-confirmation bias. It is constantly testing its own assumptions against the cold, hard reality of the market data. If the data contradicts the model is adjusted or discarded, not the data. The system is a machine for controlled failure. It is built to fail small, frequently, and without emotion, ensuring that the overall portfolio remains robust and on track to realize its long-term statistical expectation. The wealthy understand that the greatest risk is not the market, but the human mind. The system is the necessary cage for the irrational human within. The third principle is the mathematical imperative of diversification. The average person places an enormous, disproportionate bet on a single asset, their home, their company stock, or a handful of stocks they feel they understand. They believe that by focusing intensely, they gain control. This is an illusion. Control is the enemy of probability. Diversification is not about spreading your risk thinly. It is about acknowledging the inherent uncertainty of any single event and ensuring that no single failure can destroy you. It is a mathematical hedge against the unpredictable nature of the future. The wealthy understand that true control comes from managing the portfolio as a whole, not from micromanaging individual components. Imagine 1,000 small, independent bets, each with a slightly positive expectation. Some will fail, perhaps many will fail, but the aggregate result, dictated by the law of large numbers, will be a profit. The middle class, with their concentrated bets, are exposed to catastrophic risk. One bad event, one unexpected market shift, and their entire financial structure collapses. We, at Renaissance, traded thousands of instruments across every conceivable market. A loss in one area was simply noise, offset by gains in others. We did not need to be right on any single trade. We needed the collective system to be right on average. The rule is to trade the portfolio, not the position. Embrace the complexity and let the mathematics of diversification shield you from the inevitable failures of individual components. The mathematical concept underpinning this is correlation. The emotional investor selects assets based on their individual merit or based on a narrative. They buy two technology stocks because they both have great stories. What they fail to realize is that if the technology sector suffers, both stocks will likely suffer simultaneously. Their portfolio is not diversified, it is merely concentrated in a single risk factor. True diversification requires selecting assets that are uncorrelated or ideally negatively correlated. When one asset goes down, the other is statistically likely to remain stable or even go up. At Renaissance, we spent an immense amount of time and computational power not on predicting the price of a single stock, but on understanding the complex web of correlations between thousands of assets, stocks, bonds, currencies, commodities, and derivatives across every global market. Our goal was to construct a portfolio that was market neutral, meaning its performance was independent of the overall direction of the stock market. If the S&P 500 went up, we made money. If it went down, we made money. Our profit came from the small, temporary mispricings we detected, not from the broad market trend. This is the ultimate expression of the wealthy rule: to decouple your success from the emotional, narrative-driven movements of the crowd. The middle-class investor, by contrast, is a prisoner of the market's beta. They are forced to ride the emotional roller coaster of the index, experiencing the full force of every boom and bust. They mistake a rising tide for investment skill. The wealthy quant seeks alpha, the return generated by skill and system, independent of the market's movement. Diversification is the tool that allows you to isolate and capture that alpha. It is the mathematical firewall that protects your capital from the emotional volatility of the crowd. By trading a vast number of uncorrelated, small-edge strategies, we ensured that the inevitable failures of individual models were smoothed out by the successes of others, resulting in a remarkably stable, high-return equity curve. The illusion of control is the belief that you can predict the future. The power of diversification is the acceptance that you cannot, and the construction of a system that profits regardless. To elaborate on the concept of correlation, the middle-class investor practices naive diversification. They own a handful of stocks, a mutual fund, and perhaps some real estate. They believe they are diversified because they own different names. The sophisticated investor practices mathematical diversification. They understand that assets can be highly correlated even if they are in different sectors. For example, during a liquidity crisis, almost all assets become highly correlated as investors sell everything to raise cash. True diversification requires identifying and modeling the underlying risk factors: inflation, interest rates, economic growth, geopolitical instability, and ensuring that the portfolio is not overly exposed to any single one. Our models were constantly calculating the covariance matrix of all our holdings, a complex mathematical tool that measures how all assets move in relation to each other. This allowed us to dynamically adjust the portfolio to maintain a near zero net exposure to the market's overall direction. The wealthy rule is to not just own different things, but to own things that behave differently under the same stress. This is the difference between a collection of assets and a mathematically engineered portfolio. The former is subject to the whims of the market, the latter is a fortress of statistical independence. While the first three principles are the mechanics of the system, and the fourth is the philosophical engine that drives it, the relentless pursuit of data and the absolute rejection of intuition. The middle-class investor relies on intuition, on a hunch, on a feeling that a stock is due for a rise. They are trapped in the confines of their own limited experience and cognitive biases. Intuition is simply a collection of past patterns, often misremembered and emotionally colored. In a complex, nonlinear system like the financial market, intuition is a liability. The wealthy, the true quant, understands that the market is a constantly evolving, high-dimensional space. The patterns that worked yesterday may be irrelevant today. Success requires a commitment to a perpetual state of learning, which is only possible through the systematic collection and analysis of every conceivable data point. We didn't just look at price and volume. We looked at weather patterns, satellite imagery, shipping manifests, social media sentiment, and the complex interactions between all of them. Every piece of information, no matter how seemingly irrelevant, was a potential variable in our predictive models. The middle-class investor stops learning when they feel comfortable. They read a few books, they find a strategy that worked for a while, and they settle into a routine. They become complacent. The wealthy investor, the Simon's mindset, understands that the moment you stop searching for new data, new patterns, and new inefficiencies, your edge begins to decay. The market is an adversarial system. Your competitors are constantly searching for the same anomalies. Your edge is a temporary phenomenon, a brief window of opportunity before the market adjusts. This is the concept of model decay. Our models, no matter how profitable, were constantly monitored for signs of degradation. We did not wait for them to fail catastrophically. We looked for the subtle statistical shift, the 50.75% edge dropping to 50.5%, then 50.25%. The emotional investor would ignore this, blinded by past success. The disciplined quant sees this as a clear signal to reevaluate, to discard, or to rebuild. The rule is to treat every model, every strategy as temporary. The only constant is the process of systematic, data-driven discovery. The middle class seeks a permanent solution. The wealthy seek a permanent process of adaptation. The philosophical rejection of human judgment is perhaps the most difficult hurdle for the emotional investor to clear. They believe that their unique insight, their feel for the market, is their greatest asset. This is a profound error. Human judgment is slow, inconsistent, and riddled with biases. The market moves at the speed of light, and the emotional investor is trying to keep up with the horse and buggy. Our success was built on the premise that the human's role is not to trade, but to build the machine that trades. The human is the architect, the mathematician, the scientist. The machine is the unemotional, tireless executor. We sought out PhDs in mathematics, physics, and signal processing, not MBAs or traditional stock pickers. We were looking for people who understood how to find patterns in noisy data, not people who could spin a compelling narrative about a company's future. The wealthy rule is to embrace the power of alternative data. While the middle class is reading the same financial news and quarterly reports, the wealthy quant is analyzing the flow of goods through global ports, the change in parking lot sizes at retail stores, or the tone of voice in executive conference calls. This is data that is difficult to acquire, difficult to process, and difficult to model, which is precisely why it provides an edge. The market is an information game, and the wealthy understand that proprietary non-obvious information is the key to statistical advantage. The rejection of intuition is the acceptance of a higher form of logic, the logic of the algorithm, which can process millions of variables simultaneously and make a decision in milliseconds, a feat utterly impossible for the human mind. Finally, the wealthy rule is the mastery of patience, not in the emotional sense of waiting for the market to turn, but in the mathematical sense of allowing the law of large numbers to play out. The middle-class investor is obsessed with the short-term outcome. They check their portfolio daily, they react to hourly fluctuations, and they are constantly tempted to interfere with their own system. This short-term focus is a direct result of their emotional attachment to the money. The wealthy investor, having built a system based on small, positive expectations, understands that the system's true power is only realized over a large number of trials. They are indifferent to the short-term noise. A day, a week, or even a month of negative returns is simply a statistical fluctuation, a temporary deviation from the mean. They have the patience to allow the system to work because their faith is not in a hunch, but in the mathematical certainty of their long-term expectation. This is the concept of time horizon. The middle-class investor has a time horizon of weeks or months, driven by their immediate financial needs or emotional impulses. The wealthy investor has a time horizon of years or decades, driven by the compounding power of their systematic edge. We, at Renaissance, were not trying to predict the next quarter's earnings. We were trying to build a machine that would generate a small, consistent profit every day for the next 50 years. This long-term view is only possible when you have completely removed emotion from the decision-making process. If your decisions are based on logic and data, then you have no reason to panic when the short-term results deviate. You simply trust the mathematics. The rule of the wealthy is to be patient with the process, but impatient with the data. Be patient enough to let the system's edge compound over time, but be impatient enough to constantly test, refine, and discard any model that shows the slightest sign of decay. This is the ultimate discipline, the unwavering commitment to the long-term mathematical truth, even when the short-term emotional noise is deafening. The middle-class investor often mistakes activity for progress. They feel compelled to constantly buy and sell, to do something, because inaction feels like a failure. This is the emotional need for control, manifesting as overtrading, which only serves to increase transaction costs and erode capital. The wealthy quant understands that the most profitable action is often the maintenance of the system, the quiet, continuous monitoring of the data, and the disciplined inaction of letting the positive expectation play out. The system is designed to be a set-it-and-forget-it mechanism, but the human element is constantly tempted to interfere. The mastery of patience is the mastery of the self, the ability to trust the mathematics over the emotional impulse to intervene. The concept of geometric mean is key here. The emotional investor, chasing high returns, subjects their capital to massive volatility, which dramatically reduces their long-term compound growth rate. The wealthy quant, by focusing on small, consistent, low volatility returns, maximizes the geometric mean. A 10% return followed by a 10% loss results in a net loss. A 5% return followed by a 5% return results in a net gain. The wealthy rule is to prioritize the stability of the return stream over the magnitude of any single return. This is the mathematical secret to compounding. Consistency trumps volatility. The middle class seeks the lottery ticket. The wealthy build the machine that prints money slowly, reliably, and without fanfare. The long-term view is not a moral virtue. It is a mathematical necessity for the compounding of a small systematic edge. These 5 principles, the small, high-frequency edge, the disciplined, systematic acceptance of loss, the radical mathematical diversification, the rejection of intuition for data, and the mastery of long-term patience are not separate strategies. They are a unified operating system, a complete philosophical framework for wealth creation. The middle class lives in a world of narrative, where success is a story of a brilliant prediction, a lucky break, or a heroic intervention. The wealthy quant lives in a world of data where success is the inevitable outcome of a superior process, a triumph of logic over emotion. The transition from the middle-class mindset to the wealthy mindset is not about acquiring more money. It is about acquiring a new way of thinking. It is about replacing the human operating system, which is prone to error, bias, and emotional interference, with a mathematical operating system which is consistent, logical, and tireless. You must stop asking, what stock should I buy? And start asking, what is the statistical anomaly I can exploit? And how can I build a system to exploit it thousands of times? You must stop asking, how much can I make? And start asking, how much can I afford to lose? And how can I minimize the probability of that loss? The market is not a mystery to be solved by genius. It is a puzzle to be decoded by relentless, systematic effort. The rule the rich follow is simple. They have outsourced their decision-making to mathematics. They have replaced hope with probability and fear with a predefined exit strategy. They have accepted that they cannot predict the future and have instead built a machine that profits from the market's inability to be perfectly efficient in the present. I've watched people repeat the same mistakes for decades, and the root cause is always the same. They are trying to outsmart the market with their feelings instead of outcalculating it with their minds. The market does not care about your hopes, your fears, or your narratives. It only responds to the flow of capital, which is driven by data. If you want to move from the emotional narrative of the middle class to the mathematical reality of the wealthy, you must first commit to the system. You must commit to the data. You must commit to the logic. Now, I want you to take the first step in applying this mindset. If this message resonated with you, like this video, and in the comments below, write one sentence about how you will apply the principle of unemotional, data-driven decision-making to your own life this week. It could be in your investments, your career, or even your personal habits. To summarize, first, stop chasing the grand slam. Pursue the small, persistent edge, realizing that high frequency is the key to realizing statistical certainty and overcoming the noise. Second, treat every loss as a data point, not a defeat, and let your system, not your ego, dictate your exit. Ensuring capital preservation is your primary goal and overcoming psychological biases. Third, diversify radically across uncorrelated assets to protect yourself from the unpredictable nature of any single event, seeking alpha, not market beta, by modeling the covariance matrix. Fourth, reject intuition and commit to the relentless, systematic pursuit of new data, constantly monitoring your models for decay and embracing the power of alternative data. Fifth, master the long-term view, allowing the mathematics of compounding to play out, indifferent to short-term noise, and prioritizing the stability of the geometric mean over the volatility of the arithmetic mean. The mindset of the wealthy is not about a secret formula. It is about a superior operating system, one built on logic, probability, and the relentless pursuit of truth in the data. Adopt this system, and you will find that the path to enduring wealth is not a matter of luck, but a matter of mathematics.